This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. In this video, we'll discuss Fed Chair Jerome Powell's recent Jackson Hole speech and what it signals about upcoming rate cuts, the bond market, and the overall economy. We'll explore why market confidence in the Fed matters so much for investors, examine economic data driving policy decisions, and look at what rate cuts could mean for your investment portfolio. Let's start by understanding why the relationship between Fed credibility and market confidence is so important for how monetary policy actually works. While the Fed sets short term rates, longer term interest rates that affect things like mortgages and corporate borrowing are actually determined by the markets. This means Fed policy only works when investors have confidence in the Fed's ability to achieve its goals. One way we can measure this confidence is through corporate bond yields. These yields represent the interest rates investors require to lend based on risk. They generally fall when the economy is healthy and corporate profits are growing. Today's market environments suggest this confidence remains strong since corporate bond yields have fallen and are near their lowest level in years. Now, let's turn to what Powell actually said at Jackson Hole and what it tells us about Fed policy. Powell acknowledged that the delicate balance the Fed must strike between controlling inflation and supporting employment. He noted that risks to inflation are tilted to the upside due to tariff impacts, but also emphasized significant risks to employment to the downside. Recent economic reports illustrate this challenge. There are early signs that companies are beginning to pass on higher costs to consumers, which could drive prices higher. At the same time, though, the latest jobs report was much weaker than expected. So the Fed appears to be positioning for cautious rate cuts to balance these objectives. What do potential rate cuts mean for your investment portfolio? Historically, falling policy rates provide support for bond prices since existing bonds with higher yields become more valuable. You can think of it as a teeter-totter on a playground. When one end goes down, the other end goes up, and vice versa. So if rates fall, bond values should go up. The U.S. Aggregate Bond Index has generated a total return of around 4.8% this year, partly reflecting these dynamics and beliefs. Lower rates also typically reduce borrowing costs for companies, which can drive growth higher. This can also support higher valuations, particularly for growth companies, since lower interest rates mean their future profits are worth more today. Ultimately, the benefits of lower rates needs to be balanced with the valuations that are quite high right now. The best way to do this is to be prepared for a range of outcomes. Yes, we all hope for the best, but what if that does not happen? Truly diversifying with not just different asset classes, but also with different approaches and disciplines, which means don't just incorporate different stocks and bonds, but also including a mix of tactical strategies that can use quantitative, fundamental, or technical analysis. Now, incorporating tactical strategies or funds isn't about timing or predicting the market. It's about preparation. Just like when you're driving a car, if you see a pothole in the road, you swerve to avoid it. Lastly, including different alternative investments that target non-correlated returns, such as global macro, arbitrage, or managed futures, just to mention a few, are key to building what we call a multidimensional asset allocation. Now, this chart, which is commonly referred to as a quilt chart, highlights that no single asset class is always the best performer. Now, this chart is for bonds, but we can happily send you similar charts for stocks or other classes if you'd like. Simply reach out to us. But what you can see in this chart, Years like 2022, when all of the different bond types shown were negative. This highlights the importance of our multidimensional approach, as bonds should not be your only diversifier when it comes to investing. Now, I hope you found these high level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, feel free to download our white paper. You can click the link below or visit our website at dynamicwg.com or simply email us at info@dynamicwg.com. If you're an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, take care, everyone, and make smart, logical, and fact based financial decisions.